Hello, my name is Matthew DiRosario, and thank you for coming to the first outlook of the investment fund, as I am a professional fund manager and I collected $100,000 worth of investments to invest in a portfolio, and the strategy was to focus, as a hedge fund manager, was to focus on long-term investment growth. As such, the portfolio may not have had the immediate short-term high growth rate. The investment strategy was to invest over a long run for consistent growth while taking into consideration risk. The investment portfolio's target market is one that contains a comprehensive market. The investment style is that of a large blend portfolio focusing on stocks that represent the entirety of the U.S. stock market in terms of size, growth rates, and price. This strategy creates an overall portfolio that is intended to move with the S&P 500. The first outlook of performance of the portfolio is that it had a year-to-date loss of 1.83% in total market value. The negative 1.83% portfolio return was broken down into weekly returns of each stock as well as year-to-date returns of each stock. This is shown in Figure 1 of your attachment. Of note, one of the stocks that had a high return was Whole Foods Market with 17% year-to-date return, which can be directly related to the acquisition of Amazon purchasing Whole Foods. Two other stocks that had pretty high performance were Nordstrom as well as Palo Alto Networks with 13% year-to-date return and 11% year-to-date return respectively. And then as overall, the performance can also be taken into consideration for risk-adjusted returns. The risk-adjusted alpha return was negative 1.88. The beta of the portfolio is 0.96. The market return of the S&P 500 over the investment period was 0.01, and the risk-free T-bill rate was 0.89 used in this calculation. In comparing the portfolio to peers, I compared it to the S&P 500 ETF SPDR. SPDR is a peer that represents the closest ETF because this ETF represents the S&P 500. The portfolio's objective was to move with the S&P 500. As such, this ETF was chosen. The total return of our portfolio was negative 1.83%, while SPDR had a 0.45% return. This can be related to the decline in the retail industry due to the Amazon purchase of Whole Foods that had a negative effect on Walmart and other retailers, and Sandridge Energy not performing well. The risk measures can be taken into effect as well. Standard deviation of the portfolio is 0.0674. One stock that is specifically intriguing is Whole Foods Market. Whole Foods is an industry leader in organic grocery services, as well as the recent acquisition of Whole Foods. Amazon purchased Whole Foods in week 3 of the investment period and saw a 16% year-to-date or 16% weekly return after that acquisition took place. Whole Foods Market operates in the organic grocery store services, while Amazon is a technological innovation leader. This combines an interesting strategy because if these two competitive advantages can be taken into consideration, this can provide quicker groceries to market and groceries to customers potentially quicker with specific technological advances. This will be an interesting stock to watch, as well as Amazon, because over time, a technological leader with an organic grocery store leader can combine their strengths and utilize the fact that both of these industries are growing in the United States in order to provide a very strong service and a potentially very viable, strong firm. The portfolio outlook is that the outlook is to grow with the S&P 500 over the remainder of the year. I expect that the portfolio returns will be better for the rest of the fiscal year, as some stocks will be sold off of the portfolio, such as the retail stocks of Walmart and Nordstrom or Sandridge Energy, and other stocks will be purchased in various other industries such as fast food or airlines, just to keep the strength of the diversification of the portfolio. As such, the portfolio is expected to sustain long-term growth over time. Overall, the portfolio had a loss of 1.83% for its year-to-date returns. However, over time, with the long run, I expect the portfolio to grow over time with the S&P 500, as a 3-week investment period was not long enough for the strategy to work. Thank you very much, and let me know if you have any questions.